To speculate on a spike in oil prices with leverage, you're essentially making a high-risk, high-reward bet that oil prices will rise sharply in the short term. Here are several ways to do this, depending on your risk tolerance, capital, and trading platform access. 1. Leveraged oil ETFs. Easy to trade on platforms like Robinhood. Examples: UCO, 2x leveraged crude oil ETF. GUSH, 2x leveraged oil and gas exploration companies. How to use: buy UCO or GUSH before news or data that could spike oil, e.g. Middle East conflict, OPEC cuts, hurricane threats. Risks: daily compounding can hurt you if oil fluctuates wildly. 2. Oil futures contracts, CL, used by pros on platforms like TradeStation or Tration, Thinkorswim. Standard CL contract controls 1,000 barrels of oil. One move equals $1,000 gain loss. Microcrude MCL, smaller contract size, 1/10 the exposure. Leverage, often 10 to 20x, depending on margin requirements. Risks: futures can cause rapid losses if the price moves against you even slightly. 3. Options on oil ETFs, like USO. Best for asymmetric risk/reward. Buy call options on USO, United States Oil Fund. E.g., buy a $83 call expiring in 5 days if USO is trading at $80. Leverage, limited loss, premium paid, unlimited upside. Example profit potential: a $1 option could be worth $4 plus if oil spikes. 4. CFDs, contract for difference, or spread betting, available outside the US or with offshore brokers. You can go long with high leverage, up to 500x on some sketchy platforms. Example brokers: IG, AvaTrade, IC Markets. Use stop losses. 5. Binary options, high risk, high leverage, like Rollbit or Deriv. You bet whether oil will be above a certain price at expiration. Some platforms offer 5-second or 1-minute expiry times. Massive leverage, but very risky and often unregulated. Strategy tips: 1. Catalysts to watch: Middle East conflict, Iran, Israel, Yemen, etc. OPEC announcements, U.S. inventory reports, Wednesdays, hurricane threats to Gulf Coast refineries. 2. Timing: enter before news. Use technical levels, e.g. support zones, breakout patterns. 3. Risk management: never risk more than 1 to 2% of your capital per trade. Use stop losses or small position sizes. High risk example: Robinhood style. If oil is at $80 and you expect it to spike to $85 this week, buy USO 83 call expiring in 5 days for 80 cents. If USO goes to $88, that option might go to $5 plus. Potential gain: 80 cent, $5 equals 6.25x return.